JC Parets, president and founder at allcharts.com, is with us on the show. Thank you so much for taking time out. To begin with, let's start off with what's on top of everyone's mind, that breakout that we've seen in other assets like gold. Do you believe that that has the potential to sustain or even move up from the current levels?
So we like gold. We continue to like gold. We've liked gold all year. And it was really because we felt as though the US dollar was going to weaken coming into 2019. And what's really interesting is that while the US dollar hasn't gone up, it hasn't gone down either. It really has just gone sideways all year. G10 currencies have just been so quiet all throughout 2019. So the fact that gold has been able to do so well in that environment, to me, just sort of strengthens the thesis that we had coming into the year that we need to be buying precious metals, particularly gold. Now, as always, it's not quite as simple as just buy it and forget about it. I think from a risk management standpoint, 1380 is a good level. If we're above that, I think we want to remain long gold and other precious metals really too. And I think the next stop is about 1600 in gold prices.
Now, the other big talking point has been the US 10-year as well as the dollar index. What are the levels that you're watching out for here?
So for the US 10-year, I definitely think that we're near a turning point. We were here a couple of years back in 2017, and rates really ripped higher. So I think the path of least resistance at this point is higher for US interest rates, and we want to be selling bonds accordingly. And the risk management, the thesis really only holds if US 10-year yields are above 2%. Particularly 206 is really the level we're watching. But if we're above that 2%, 206 level, I think we could be selling bonds. I really think we're better off. But if interest rates start breaking down again, I think there are bigger issues out there. I don't think that the stock market's doing well in that environment either. But I think the higher probability outcome is rates rip from here and bonds sell off, and that's probably good for stocks. I would be betting. In terms of the US dollar, 98. That's the level. No question about it. If we're below 98 in the US dollar index, we need to be not only buying things like gold, which that's the obvious answer, but just thinking about making investment decisions that would benefit from a further weakening in the US dollar. Things like emerging markets, particularly on a relative basis. Not just India, right? Not really India at all, but more so some of the other emerging markets, maybe some of the emerging markets that have more exposure to natural resources, right?
Right. Okay, so, looking at the first half of the current year, Indian equities have underperformed the US benchmarks. Do you see this reversing, though, in the second half at all?
Yeah, 11,750 for the Nifty 50. That's the level. So for me, I think the path of least resistance is higher for Nifty 50. I think stocks in general, but when it comes to relative strength, stocks in India just look better than anyone else. So when you talk about maybe some relative weakness, I think we need to put that into context that while sure, maybe the Nifty hasn't done as well as the Dow in the short term, bigger picture, when you compare it to indexes around the world, it looks fantastic.
Okay. Is the mid and small cap underperformance, though, becoming increasingly worrying for you? Or do you think we may be at maybe a bottom or end of the pain?
Well, remember, I think that's a great question because when small caps first started to underperform large cap indexes, that's when stocks all over the world peaked, right? That's when emerging markets peaked. That's when the S&P 500 and the Dow in America peaked. That's when bank stocks peaked in America, right? That was a very important point. So when small caps start to outperform large caps, I think that will be an indication of risk appetite all over the world, definitely in India as well, for sure. I think more stocks start participating, but globally, I think it's bigger than that. You start to see, and by the way, we're seeing the small cap underperformance in the United States too, not just in India. So it's a global phenomenon. So I think if you see rotation into small cap, particularly on a relative basis, I think that would be evidence of risk appetite that the world is ready to move on from this 16, 17-month consolidation that, quite frankly, Nifty 50 has ignored, right? Keeps making new highs. I like the relative strength.
Now, you've been bullish on Indian financial stocks. So at the moment, given that they're in favor, what is it that you like?
Yeah, the strength really is in the financial services space. There's no question about it. I mean, just look at HDFC, right? I was with a colleague in the Netherlands, in Amsterdam, a couple of weeks ago, and he was telling me how, Indian banks, particularly HDFC, have such high multiples. They're pricing in so much growth. And my argument as a technical analyst was they're probably pricing in all that growth for a reason. So we don't really care why. We're going to go with the trend, and money's flowing in that direction. Sure, Indian banks have the highest multiples and are the most expensive in the world. You know what? They're probably expensive for a good reason, and you get what you pay for. So for me, I like that. I'm looking at 2,000 in HDFC. If we're above that, I think we have to be long, and I think there's 50% of upside. I think it sees $3,000.
So what do you want to do in terms of your outlook for the FMCG index? Because that is hovering near the 200 DMA. So what's the advice?
So for me, the fast-moving consumer goods are still in a mess, right? They're just trading sideways. I think at best, that suggests that we just wait and stay patient. I don't see any reason to get aggressively bullish there because there are other areas that are already working out, as we mentioned. Hindustan Unilever still has work to do, right? For me, if any of them, I like Havells. Havells above 750. So if Havells India is above 750, I like that one long within the fast-moving consumer goods space. If it's above 750 with a target just below 1,000, I think that's where we're going.
Do you reckon, though, that the breakout in pharma was a false one?
There's no evidence whatsoever that pharma has bottomed out. It really is just messy. And I think it gets back to, if we're going to be buying leadership, let's buy leadership. I don't think there's any reason to, get cute and try to, be the first ones in the stocks that aren't working. I'd rather be in the stuff that's already working. And pharma, as you mentioned, it's just not working. I mean, that's just the bottom line. So I think we remain patient in that sector. The way I look at it, the market, I think, is ultimately going to break out. So we're comparing it to kind of like a big beach ball in the pool, right? When you hold it down, it's holding the pressure. And then when you let go, it shoots up into the air. That's how we want to look at stocks showing relative strength, like some of these financials, some of the other areas in the market, and pharma's just not that.
Right. In a recent blog, you mentioned about long-term breakouts in both L&T as well as SBI. Are those patterns still intact, and what levels are you looking at for over there?
So for State Bank of India, I mean, it's really interesting. I really see this breakout right at 350 on State Bank of India. If we're above that level, we're talking about the highs from the previous couple of years. If we're above that level, I think we have to be long, and 425 is the target there. In Larsen and Toubro, I'm looking at 1500. The way I learned it is the bigger the base, the higher in space. And this multi-year base in Larsen and Toubro and LT, to me is tremendous. So 1500 from a risk management standpoint. If we're above that, I think we have to be long. And then the target is 2100.
What are you going to do with the auto stocks near the support levels? Do you think that you can bottom fish?
I don't really like the automobile stocks, at least not yet. I think it still needs some time. If you recall, the automobile stocks peaked in early 2018, right when everything started falling apart. So for me, I would look at the automobile stocks more so as information, right? So instead of trying to get cute and bottom fish those, I'd rather be investing in the ones that are already working. But then we can look at the automobile stocks as information, right? That's evidence of risk appetite and positive rotation, in my opinion. So I think we look at that for confirmation of our bullish thesis more so than trying to buy them.
All right. Thank you so much for joining in and giving us a view as to where you're seeing, breakouts, the important levels to map out on the index, as well as outlook for mid caps. That's the word from JC Parets.